You're doing everything right. You're putting money away every month, sticking to your plan, and watching the market move. But your balance barely budges. It feels like you're doing all this work for nothing, right? You check your account again and nothing's changed. So you start to ask yourself, why keep going? Maybe all this talk about compounding is just that talk. Maybe it doesn't even work. But what if I told you there's a moment when everything flips, when your hard work finally pays off and then some? Stay with me because in the next few minutes, I'm going to show you the framework that explains exactly when that happens and how you can make compounding work for you, even when it feels like nothing's happening. Let's dive in. Meet Sarah. She's 29, a hard worker with a steady income, and she's been faithfully investing $250 every single month for the past 4 years. Like many others, Sarah thought she was on the right path, following all the rules, staying consistent, and diversifying her portfolio. But when she checked her investment account last week, her balance was just over $12,000. 4 years of disciplined investing, and this is all she had to show for it? It's a tough pill to swallow. Sarah's first thought, is this really worth it? She wonders if she's doing something wrong, if there's a shortcut she's missed, or if maybe this whole compounding thing is just a myth. The worst part? This is the exact moment where most people give up. They start second-guessing their strategy, jumping into risky investments, or pulling out altogether. But here's the truth. Sarah isn't doing anything wrong. She just hasn't reached that pivotal moment when compounding finally starts to take off. The problem is, most of us expect instant results. We're conditioned by social media, the headlines, and those overnight success stories. But real wealth, it's built in the slow and steady grind. And the real breakthrough happens when you hit a specific point in your investment journey. This is where the 7531 rule comes in. This rule is your map, guiding you through the slow beginnings of compounding until the real magic happens. So, what does this rule look like, and how can it transform Sarah's situation? Let's break it down. The first part of the 7531 rule is the 7-year commitment. And yes, I know it sounds like a long time. 7 years? It feels like forever when you're staring at a modest balance. But here's the thing. If you can commit to just 7 years, you'll start to see your money working for you in ways you can't even imagine right now. In fact, if you look at data from the S&P 500, there's something pretty incredible you'll find. When you invest for any random 1-year period, you have about a 74% chance of seeing some sort of return. That's not bad. But stretch that out to 7 years, your odds of making money jump to an overwhelming 95%. And here's the kicker. If you stay invested for 7 years, the returns are positive every single time. Think about it. 7 years smooths out the chaos. It helps you ride through the inevitable market crashes, recoveries, and down years, and come out on the other side with something meaningful. But less than 7, you're at the mercy of the market cycles, gambling on which direction the wind is blowing. This is the first shift that needs to happen in your mindset. When you invest for just 1 or 2 years, you're constantly checking your balance, hoping for something substantial. But when you commit to 7 years, your mindset changes. You stop focusing on month-to-month progress and start thinking in terms of the bigger picture. It's the same as planting a tree. You wouldn't look at a sapling and judge its growth after just 1 year. Instead, you'd focus on whether it's still growing after 7 years. You're not just planting seeds, you're planting the foundation for long-term wealth. So now we know that committing to 7 years is key. But here's where most investors go wrong. They put all their money into the same type of assets. That brings us to the second part of the rule, 5 categories of diversification. Diversification is the bedrock of any successful investment strategy, but not just any diversification, 5 distinct categories that work together to create a balanced, resilient portfolio. Here's how it breaks down. 1. Broad market index funds. This is the foundation of your portfolio. Think of funds like the S&P 500 or total stock market indexes. These give you exposure to hundreds, even thousands of companies all at once. When the economy grows, so do these funds. Historically, they've returned about 10% per year over the long term. For most investors, this should make up your biggest portion of your portfolio, around 40 to 60%. 2. Dividend-paying stocks. The next category is companies that not only grow in value, but also pay you cash regularly. Companies like Coca-Cola, Johnson & Johnson, or Procter & Gamble have been paying dividends for decades. Dividends give you something even when the market isn't climbing. You can reinvest those payments, allowing your portfolio to grow faster, or later in life, use those dividends as a source of passive income. This category should make up about 15 to 25% of your portfolio. 3. Small and mid-cap growth stocks. This category is riskier, but offers greater rewards. These are smaller companies with more room to grow, and they tend to be more volatile. But historically, small-cap stocks have outperformed large-cap stocks. From 1926 to 2020, small-cap stocks returned an average of 11.9% per year, compared to 10.2% for large-cap stocks. While it's riskier, it's a crucial part of capturing higher returns. Aim to allocate 10 to 20% here. 4. International exposure. Many investors focus only on U.S. companies, but the world is a big place, and there's massive growth happening beyond the U.S. In fact, the U.S. makes up less than 60% of the global stock market. If you're only invested in U.S. companies, you're missing out. International markets often don't move in sync with U.S. stocks, so when one market drops, another could rise. This balance reduces risk and creates more opportunity. Aim to invest 10 to 20% here. 5. Defensive assets. This is your safety net. Defensive assets like bonds, treasury bills, or even a small cash reserve provide stability when things get tough. While these assets don't grow much, they don't crash either. When the stock market drops, your defensive assets may only fall a fraction, giving you the stability to ride out market volatility without making panicked decisions. Depending on your age and risk tolerance, these assets should make up 10 to 30% of your portfolio. Younger investors can allocate less here, while older investors might want more. Why is this 5-category structure so important? It's all about protection. Imagine you put all your money into one hot tech stock. It doubles in value and you feel like a genius. But then the market crashes and that same stock drops 60%. Now you need a 150% return just to break even. That's not compounding. That's gambling. But when you spread your investments across 5 categories, something is always working for you. If stocks drop, your bonds hold steady. If the U.S. market slows down, international stocks might pick up the slack. Even when the market stalls, your dividends keep coming in. This resilience allows compounding to continue growing without major setbacks. Now that we've covered how to structure your investments for success, let's talk about the real challenge, the emotional roller coaster. This is where most investors falter. And that brings us to the third part of the 7531 rule, 3 emotional phases. The real test of your investment strategy isn't the markets or the economy, it's your own emotions. Let's break down the 3 emotional phases that can derail your progress. 1. Doubt. This phase hits hard in the first few years. You're investing consistently, but your balance looks pretty pathetic. You see your friends making quick money in crypto or day trading, and it makes you question everything. Maybe I'm doing something wrong. Maybe I should be more aggressive. Maybe this whole compounding thing is just a myth meant to keep people like me in the dark. This doubt whispers in your ear every time you check your account. You begin wondering if all the time and money you've spent is just wasted. The temptation is to abandon the plan, chase after short-term gains, or jump into something that feels more exciting, like a friend's startup or a trending stock. But here's the thing, doubt is normal. It's the first hurdle every investor faces, and if you push through it, you're closer to the breakthrough. 2. Frustration. This phase kicks in around years 3 or 4. By now, you've invested thousands of dollars, but your returns are still lackluster. The growth doesn't seem exponential. It feels linear. It's slow, and for many, it's downright discouraging. This is when most people start questioning their investment strategy. They might pull out their money to make an emergency purchase like a new car or a vacation, or they might throw it into something that feels more exciting, like a friend's startup or a trending stock. But here's what you need to understand. Frustration is a sign you're close. You've built the base for compounding to kick in. It's like preheating the oven. Quitting now is like turning it off just before the food's about to cook. If you push through this phase, you're almost there. Panic. This is the hardest phase, and it usually happens when the market crashes. Let's face it, it will crash. In 2008, the market dropped 37%. In 2020, it fell 34% in just a few weeks. During these crashes, your account balance might fall below what you've contributed. Fear will grip you. You'll think, if I don't pull out now, I'll lose everything. But the reality is, every single market crash in history has been followed by a recovery. The 2008 crash fully recovered by 2013. The 2020 crash bounced back by August of that same year. If you sold during these crashes, you locked in your losses and missed the recovery. But if you held on or even kept buying, you came out ahead. Panic is the most dangerous phase because it tricks you into thinking you're protecting yourself when in reality you're sabotaging your future. The secret to surviving this phase is staying grounded. You need a system in place that prevents you from making irrational decisions when fear takes over. So, how do you survive these three phases? It's simple, really. First, stop checking your account every day. Set a rule for yourself. Check it once a quarter or even once a year. The more often you check, the more emotional you'll get, and the more likely you'll be to make rash decisions. Second, automate everything. Set up automatic contributions so you don't have to think about it. When the market dips, those automatic investments buy more shares at a lower price, which is known as dollar cost averaging. It's one of the most powerful tools you can use to build wealth. Third, track your progress differently. Don't just look at your balance. Look at how many shares you own and how much you've contributed. Celebrate consistency, not just returns, because in those early years, consistency is the real win. Finally, educate yourself on history. Read about the 2000 dot-com bubble, the 2008 financial crisis, and Black Monday in 1987. Every time people panicked, and every time those who stayed invested came out ahead. When you understand the history of markets, you stop reacting emotionally. You realize that these phases are all part of the process. Now that you understand the emotional phases, let's get to the final part of the 7531 rule: one annual increase.